Hey there, I hope you're having a great day. My name is Thomas. I'll be taking you through a presentation on a company I've been researching for the past couple of weeks called Aeva. So before diving in, I quickly want to go over the 5 attention points that I have when picking stocks. I look for exponential growth opportunities, but driven by fundamentals, so with a good strong business model, no meme stocks, things like that. Championed by experts if possible. It's always good when there are big name investors involved. I have a high risk tolerance. Sometimes these things don't work out, which is fine, because when they do, usually the return can be quite impressive. I have a long time horizon, and I think that's key to linking these different concepts together. You need to give these stocks the time to figure out their business model and have the accelerant that makes the stock price go up. And sometimes it can take years. Which is fine, because the sooner you get in, the lower the price you can usually buy it for. And along the way, they might have ups and downs, which give opportunities to buy. So just a quick disclaimer, these are just my opinions. This is not investment advice, do your own research, all of that. And then quickly, some content. So these are the different subjects we're going to go over in more detail. So in a nutshell, why I think Aeva is a great company. It's a growth stage company, so they have their first revenue, but no profit yet, so they're making losses at the moment. They have really strong in-house developed technology, so it's a LiDAR company. LiDAR being, let's take the definition, LiDAR, light detection and ranging, is a remote sensing technology that measures distances by emitting laser pulses and analyzing the reflected light. As we'll see, they don't just measure distance. They have a hardware solution with a software on top, an AI-driven platform that interprets the signal from the LiDAR. A strong founding team with the founding CEO and CTO still running the company, and they have a good investment of about 11% in total in the company. The company rides multiple trends, so robotics, autonomous vehicles, autonomous manufacturing, drones, all really interesting markets. They have partnerships with big names in their different verticals, their different business lines. A fabless manufacturing setup, meaning that they don't have factories, which allows them to go on without spending too much on capex, too much investment, and it enables them to scale quickly. And they have about a year and a half of runway in terms of cash and facilities, given their current burn rate, so money to pay for the losses they have on their way to profitability. And they have almost no debt, which is great. A quick history, so founded in 2016 in the US, in California. They did first Series A, so that's when you raise money after your initial seed round. 45 million by Lux Capital and Kahn Partners. These are still shareholders today. They listed via SPAC on the New York Stock Exchange. SPAC, basically a bag of money that's listed on a stock exchange, merging with a company, which is quite a time-efficient way of going about things. In 2023, Celebra Capital takes a position in the company. They still have a very significant position. They're the majority shareholder. And they installed a capital facility that the company might make use of in the next year. In 2024, they did a 1-for-5 reverse stock split. Their price got like below what these exchanges usually accept. And when you do a reverse stock split, you basically give 1 share for every 5 shares. So let's say a stock is trading at 20 cents, it will then trade at $1. In 2025, they changed their listing from the New York Stock Exchange to the NASDAQ, which I think makes sense. It's more technology driven, and that's where a lot of these different types of companies are listed. And in 2025, in May, they started a strategic collaboration with LG Innotek. They both took a share of the company, and there's a lot of joint development going on. A really strong party, so that's good. Then looking at the founders, so the CEO, I'm going to butcher these names, but let's say Soroush is first name. So currently the CEO, really smart guy, Stanford background, founded a company that he has sold, so that's always a good reassuring thing. And then later started working at Apple in sensing, which is probably where he met Mina, the co-founder and CTO. So Mina started working at Nikon, also a lot of laser-related stuff, so they're really experts, these guys, and then worked at Apple for a while. Seeing them communicate their vision very clearly and seeing their background gives me some good faith in this team. Then looking at the ownership, it's concentrated in quite a small group who do seem to be like aligned long term. So looking at the biggest shareholder, Celebra Capital, like I said, they took a position a while back, so almost 29% stake in the company, worth around $250 million. So this is an investment firm focused on mid-cap. Their founder, Dan Gibson, is on their board as well, as we will go into. Then the second block, so the two founders, like I said, they have about 11%. The Series A backer, like I mentioned, all the way back in 2018, they did the Series A for $45 million. And these two guys are still on the board today, or shareholders rather. One of them is on the board. And then the strategic partner that was announced, taking 6%. So just to give the definition, the collaboration combines the partners' world-class expertise. So that's LG Innotek in global manufacturing and electronics innovation with Aeva's proprietary technology. And we'll go into a bit of that next. Then the board of directors, so basically supporting the management team, overseeing them. Like I said, Dan Gibson from Celebra, so the company that owns around 30%, seems to have a good banking career. Then Harash, I think, from Khan Partners. So this is one of the guys that did the Series A round. On the board, it makes sense, 6% ownership. And then you have two guys that are more with a manufacturing background. So Dr. Stefan Sommel experiences some big German companies, as well as in the CEO role, so that can be quite interesting, probably in terms of connections to that industry. And then Stephen Zadeski, who has worked in operations at Apple for about 20 years. Interestingly, before he left Apple, apparently he headed the Project Titan, which was Apple's project to create a car. He might have influenced also a bit the manufacturing model, which reminds me a bit of how Apple does things. But more about that later. So quite a solid board of directors, 50% finance, 50% business, I would say. So let's have a look at their technology. I'm by no means an expert on LiDAR, but this is what I gather from their different presentations. So in LiDAR, they compare their technology to a more general technology on the market, which is called time of flight. They have a method called frequency modulated continuous wave. The difference between the two, one major difference is that it detects not only range, so how far an object is, but also the velocity, the time of travel, which I understand has to do with the fact that there's a continuous wave of laser being emitted. The level of precision is different, so they can be precise on a very short distance, and they can be very precise, as we will see, or at a longer distance, which is not necessarily the case, I understand, with time of flight. So that means they can also go up to 500 meters, where in time of flight it's less than 200 meters. There's no issue of blooming or ghosting, so this has to do when, for example, there's direct sunlight facing the LiDAR, it gets interrupted. So that doesn't happen with FMCW. And their technology allows it to be integrated on a chip. which for their manufacturing is really interesting. So a couple of reasons why their technology might be superior to the existing technology, and they started this back in 2016. So they've been betting on that for a long time, and you still have a lot of companies who are more on the time of flight side of things, as we'll see. So this technology gives them the ability to play in a range of different markets. The fact that it's accurate on different type of ranges, for example, makes it useful for both manufacturing on a microns level, so really in the near field, as they call it, in the mid-range when it's measuring in millimeters for robotics, and long and ultra range when you need to measure in centimeters for automotive and a few other use cases. And just to illustrate the accuracy, it could even be used for contactless biometric sensing. So you can measure someone's heartbeat from a distance. So biometrics then becomes a possibility. And so this is really where Aeva shines. So they spent about 500 million in R&D developing the laser on chip that you see here. So they developed the whole laser element and the processing unit sitting here on this chip, as you can see. And what a benefit that they claim with their tech stack basically is that they have one unified perception platform, as they call it, with their LiDAR model, their processor on a chip, with their perception software on top of it. And then, so that's sort of a modular approach that will be the same for every product, but they can tweak the different layers of the stack to best fit the purpose that they're working for. And they have designed this in a way that it can be mass manufactured, so for simplicity. And so on the right here you see a bit some views of the top part of the stack, so the perception software. So here you see the long range stuff, seeing the cars in infrastructure too, like on cross points and things like that, speed enforcement, and then more the manufacturing side of things, quality control, stuff like that. And so, like I said, with this stack, they optimize it for different products. So this is the lineup that they currently have and they're rolling out. And each of these products play in the different segments that they want to play in. For starters, so this is where they start to roll out. So automotive, they have Atlas Ultra. Manufacturing for quality control, automated assembly, vibration and speed, they have their Eve models. And then for more the infrastructure and transport part, they have Atlas Orion. So different products for different segments, because there's different level of accuracy needed. And quite excitingly, at their Aeva Beyond Day, Aeva Day Beyond the Beam, they announced a next generation chip, which will help them to catapult into the next sectors. So just to quote what Mina, the CTO, mentioned, our next generation all-in-one chip, photonics and processor in one module, optimized for 10 times lower power and dramatically smaller form factor. This enables us to push into markets that have even more compact and power-sensitive applications like mobile robotics, industrial arms, consumer devices and drones. And so you can see it here. This is like a pretty tiny, and you can indeed see it fit here. So this is basically the second part of the verticals that they want to attack next to automotive manufacturing and then defense, robotics, consumer. So then you come a bit to the more fuller vision for Aeva, playing in all these different verticals with products tailored to these different verticals. So a current assessment, I think this is coming from ARC Research, is that that's a market of about 80 billion, of course not being entirely captured by Aeva, but they would like to capture a good part of it. And so again, in the words of Mina Resk at Beyond the Beam Day, we will be releasing new products, entering entirely new markets, defense, robotics, consumers. It won't just be depth sensing, we will plan to integrate multiple sensing modalities into single intelligent devices. So they have quite concrete plans of attacking these different sectors, which is exciting, because that's where the growth is going to come from. Then a few words on their manufacturing model. So, like I said, they have a fabless manufacturing model, meaning they don't have factories, to have minimal investment and maximum scalability. How they did that, they focused on minimizing the number of parts used in their products. So really designing it for simplicity and designing it for automated assembly, which means that they can really scale up, and then working with world-class partners to produce it. So I don't have every detail on this, but just high level, if you take a stab at the approximate supply chain, you would get to something like this. So Aeva really does the design and development. They have their in-house engineering team that designs their proprietary technology and sensing systems. All that knowledge they give to their partners of how to manufacture, starting then with Tower Semiconductor, so they produce the semiconductors, manufacture silicon photonic chips and related components ready for integration into LiDAR models. Then Fabrinet and Jabil, in some type of combination, do the chip module production and assembly. So the output is a fully assembled and tested LiDAR chip module. So basically the part we just saw, the chip with the processor and the laser unit on it. And then handing it off to LG, Innotech and others to produce the final products that we saw for the different product categories, the Atlases, the Eves. Their approximate supply chain. And then in terms of their businesses, like I said, they're starting in these first three verticals: automotive, manufacturing, automation, and smart infrastructure and transport. In the words of Sarouche, again at Beyond the Beam, we have already started shipping in automotive, including fleet deployment, and we are seeing commercial rollouts in manufacturing, automation, and infrastructure. We expect larger scale production programs to begin later next year, planning to double our production capacity to 200,000 units annually. They have 100,000 today. So they're starting really in automotive, but making ways into these other sectors next year. All pretty big parties, and these are big name customers, so that's interesting. Then in terms of revenue, so this is from their Q10, a table of the split. So about 85% of their revenue in Q2 2025, around 5.5 million. 85% of that was in North America, 9% EMEA, and 6% in APAC. And in terms of split of works, so the first one, recognition point in time, that is product revenue, and the second one is more non-recurring engineering services. So now having a look at their financials, these are their Q2 2025 results. So as you have seen before, the quarter ended with around 5.5 million in revenue, a current loss of around 34.9 million. And when you look all the way down, they have a really significant loss, about almost 200 million. So a lot of this has to do with warrant liabilities and share subscriptions that they need to mark to market. So they need to value it in the way that is accurate with the market. And since their shares have gone up a lot, they've had to increase the value of that, which leads to an impact in their P&L. As they say in their 10Q report, they don't expect this to have result in cash settlement. So it will not actually hit their cash flow like that. Looking at the past 4 quarters here, you see nice growth taking up. They've given some interesting guidance in that Beyond the Beam call. Sorry about that. So they expect, so this is Saurabh, the CFO, who also owns 0.7% of the company. The guidance he gives for full year 2025 is that revenue will increase by about 100 to 110% versus last year, which would mean that they end up at around $80 million in revenue, and their non-GAAP OPEX to decrease by around 10 to 20% versus 2024. So OPEX being operational expenses, so salaries, R&D, all that stuff. And the non-GAAP part is basically excluding the things like share-based compensation. So people get shares for their as part of compensation, and maybe litigation fees and things like that. People differ in opinion if that's a valid way to look at it, but let's take it for now. And then in terms of long-term guidance, what they gave was quite interesting. So they expect 100% annual growth of revenue on average in the coming years. They expect their OPEX to grow by about 5 to 15%. So that's great on their way to profitability, of course. Your costs need to grow a lot less than your revenue. Their margin, non-GAAP margin again, they target 35 to 45%, and their long-term target is around 50%. So that will be very healthy. So exciting stuff. In terms of valuation, you see the growth a bit in revenue that they've had. So mind you, on the left axis you have revenue, the dark green, so 0 to 12 million. On the right axis you have net income, which is more in the order of 0 to 180 million. So the company, like I said, is making losses today. A big chunk of that is also due to this share-based compensation that they give. It's not all cash, but still they have losses that they need to compensate with cash. So their current actual cash burn is around $120 million. Their current cash and equivalents, cash equivalents sits at around 50 million. And they have this standby equity purchase agreement with Celebra, the company that has 29% of their stock, or around 125, so in total 175. So they should be good with that for another a year and 4 months. And like they say as well in their thank you statement, they expect to be okay for the coming 12 months. After that, they will probably need to raise in some type of way, leading to dilution for the current shareholders. When you give out shares, there's more people holding the same company. But that's the name of the game with these type of companies. And then looking at their share price, so it went really parabolic in the beginning when the SPAC just listed, reaching about 100, I think, of all-time high. Then it went down, which I think it's healthy, basically, given the how mature their technology was. They're only now starting to ramp up their revenue with the expectation that we just mentioned. Lately, they've been having a nice rally, especially following partnerships that were announced. So today, sitting at around $16.35 per share. Analysts are in general quite positive, followed by quite a few who have buy ratings. So that makes sense. But still, their market capitalization, so the price of the stock multiplied by the stocks outstanding, is around 921 million. So people saying it's worth 921 million. Whilst their current sales are expected to be like 18 million in this year. So we don't have a lot to compare on, but just a simple exercise. If you take the price of their the price of the company versus the sales that they have a price-sales ratio of above 100, which is really high. So I did a bit of an analysis here, like compared to the 2024 revenue, that would be around 100. If you look at the past 12 months of revenue and you compare that to the value of the company, it's around 66, I think. And then taking that projection of 100% revenue growth, down the line, you see that this is what it does to the price per share, price per sale. And just for comparison, NVIDIA is at around, I think, 27, and the average for manufacturers of fabless semiconductors, which is what they compare themselves to a bit, sits at around 4, I think. So it will take quite some time before this valuation is in line with that type of price to sales ratio. But then again, this is a really interesting growth opportunity. So it makes sense that the valuation is a bit out of whack. Doesn't scare me, at least. Then looking at competitors. So I've taken like the top 5 LiDAR competitors that are listed today. So Aeva, Luminar, listed on the Nasdaq as well. Ouster, listed on the Nasdaq, New York Stock Exchange. Innovis, listed on Nasdaq and Hesai. So in terms of technology, there are some differences. Luminar has time of flight, so not super exciting. The others are also more time of flight. Actually, they're the only one with this FMCW technology that has the velocity and the range. But I think these are also interesting players. In terms of management team, so we've talked about Aeva. Luminar is in a bit of a pickle. I think the founder got fired for inappropriate behavior or something like that, so that's not a great sign. Ouster is a bit more proven. They've been capital efficient, also close to profitability. Innovis, so smart guy, ex-Israeli military expert, tech expert, and Hesai being run by a couple of optics and robotics PhDs. In terms of market, all different variants of autonomous vehicles and robotics. So that makes sense. Maybe Innovis is a bit more on just the robotics, the automation part. In terms of country of origin, so the first 3 in the USA, Innovis in Israel, and Hesai in China. In terms of finances and financial runway, so Aeva we've discussed. Luminar has some cash and a bunch of facilities, but quite a lot of debt, more than 400 million, and a burn rate that's really high, 225 million. So together with the trouble here, that sort of takes them off my list. Ouster doing great, with enough cash, minimal debt, and close to profitability. Innovis, also not bad, burn rate versus cash there. And Hesai is quite a monster compared to the others. Also probably profitable this year. The way I analyze it, I don't go as deep as I go into Aeva for every company. I basically sort of dig into a company until I find things that I don't like. When I see stuff that I like, I keep going. So for Luminar, for example, it was a bit the trouble at the management team level. At Ouster, a lot of the communication didn't seem like as aggressive and ambitious, and I didn't see a lot moving in the last year maybe. Innovis a bit too much focused on automobile, and Hesai, maybe I should look more at Chinese stocks, but for now that's a bit of a riskier bet for me because I don't know that market as well. So I by no means want to say that all these other companies are not worth your time. Aeva just stands out for me. And then in terms of risks, I don't see a ton of red flags. Maybe the fact that their valuation is relatively high given their revenues, but I have a couple of other companies that are doing really well, which are in a similar spot. Cash burn, I mean, they will need to do something to generate cash to pay for their cash burn, which might lead to dilution, but okay, that comes a bit with the territory. I'm sure the guys on the board and the investors are great. It's just I didn't hear of them that much, and I don't see like really high profile names like, I don't know, A16Z or ARC, like the really the royalties of finance. It doesn't mean it's bad, it's just something I notice. Then in terms of market and tech risk, so a lot of talk around LiDAR is the fact that Tesla doesn't use LiDAR, they use cameras. I'm not going to say Tesla is wrong. I love Tesla, I have quite a big position in it, but just the fact that Tesla manages to make it work with cameras doesn't mean the rest of the industry can. So okay, let's see what happens there. And then in terms of global supply chain, so one of their strengths is their fabless manufacturing model and their partners all across the globe. You buy in a lot of expertise, but as we know, there can be quite a lot of disruptions in this world. So I mean, they're quite sensitive to that. I also wonder, as a US company and the trends that are happening there, to bring manufacturing onshore, and I think this is really the type of manufacturing that they want to bring onshore, how that will evolve in the future, and if they will make that move towards sourcing more from US suppliers, but that's not necessarily a risk. So to end where we began, to me, it's a solid company. It's a type of company and type of fundamentals I like to invest in. Definitely do your own research and see what you feel comfortable with, see at what price you would be comfortable. I know I will be building a position when the time comes and there are opportunities in terms of price. For now, thank you for sticking with me to the end. This is the first one I did, so any builds you have, definitely leave it in the comments wherever you find this. Yeah, and reach out. Hope to see you next time. Thanks.